Welcome to the Deep Dive. We're here to crack open the numbers and the nuances behind the latest corporate earnings.
That's right. And today we're tackling Target Corporation. Their Q2 2025 earnings call just dropped on August 20th.
We've gone through the presentations, the transcript, all the analyst takes, really digging in.
And our goal, as always, is to give you the clear, actionable insights from all that information.
Exactly. So, Target, it feels like they're at a bit of a crossroads, doesn't it?
It really does. You look at the Q2 results, and, well, some numbers edged past what analysts expected.
Right, a slight beat here and there.
But the market's reaction was pretty skeptical initially. Lots of caution.
Yeah, you definitely felt that. Concerns about the leadership change, those ongoing macro pressures like tariffs. It's a lot.
It is. So let's start with the results snapshot, just the core numbers to set the scene.
Okay, so Q2 revenue came in at $25.21 billion.
Which, like we said, was just slightly ahead of consensus estimates. A small positive.
But crucially, that's still down 0.9% compared to last year.
Correct. And comparable sales, or comps, that key metric for retailers, they dipped 1.9% overall.
And that overall number kind of hides a split.
Yeah, it really does. If you break it down, physical store comps, people actually walking in, those were down 3.2%.
Oof, that's notable.
But the digital side showed strength. Digital comps grew a pretty robust 4.3%.
Okay, so online is picking up some of the slack. And that's better than Q1, wasn't it?
It was, yeah. A sequential improvement shows their online strategy might be getting, more traction. The shift to digital is definitely still happening.
So sales are a bit of a mixed story. What about the bottom line? Profitability.
Similar kind of nuanced picture there. GAAP and adjusted EPS both landed at $2.05.
Which beat the sort of Main Street consensus, LSEG and the like.
Right. But interestingly, it missed the higher estimate from Zacks. So not everyone was impressed, you could say.
Gotcha. And margins, always critical in retail. How did they hold up?
They felt the pressure. Gross margin dipped to 29.0%. That's down 100 basis points, or a full percentage point year over year. Yeah. And operating margin followed, down 120 basis points to 5.2%.
So less profitable on each sale. What drove that squeeze?
Primarily two things, according to management. Ongoing merchandising adjustments, so tweaking what they sell and maybe some markdowns, and those tariff-related costs we mentioned.
Tariffs are just relentless.
They are. But there was a bit of good news offsetting that pressure. They saw improvements in inventory shrink.
Shrink. Let's quickly define that. It's basically inventory loss, right?
Yeah.
Theft, damage, errors.
Exactly. It's product disappearing without being sold. So an improvement means they're losing less inventory.
Which flows directly to the bottom line. A good operational win.
A very good operational win, especially when other costs are rising. It helps cushion the blow.
Makes sense. So given this Q2 performance, did they change their forecast for the full year?
Well, notably, no. They reaffirmed the fiscal 2025 guidance they'd previously set.
Oh, interesting. So they're holding firm.
Yeah. Still projecting a low single-digit decline in comparable sales for the year. And the EPS ranges remain the same. GAAP EPS between $8 and $10, and adjusted EPS between $7 and $9.
So sticking to the plan, despite the headwinds, suggests maybe some confidence or at least acceptance of the current environment?
Could be. It certainly sets the stage for the deeper strategic discussion. Let's get into that now.
Absolutely. And you can't talk strategy without talking leadership. The huge news was the CEO succession plan.
Definitely the biggest personnel announcement. The board unanimously elected Michael Fidelk, the current COO, as the next CEO.
Effective at the start of fiscal 2026.
Right. And they stressed this wasn't sudden. It followed a multi-year planning process, looking inside and outside the company.
And Brian Cornell, the current CEO, he's finishing up after the Q3 call, after 11 years.
Correct. End of a long tenure.
Right.
So Fidelk steps in. It's a pivotal moment.
Hugely pivotal. So what's Fidelk's vision? What did he say his priorities are?
He laid out three pretty clear strategic priorities. First, reestablishing Target's merchandising authority.
Merchandising authority. What does that mean in practice?
It means really leaning into style and design, making it feel like Target across all categories, not just, the occasional designer collaboration, pervasive style leadership.
Okay, doubling down on that Target perception, but making it core to everything.
Exactly. Second priority, elevate the shopping experience, both in stores and online. Make it consistent, maybe even inject more joy, as he put it.
Joyful shopping. Yeah. Interesting phrasing.
And third, leveraging technology more fully for speed, for guest experience improvements, and for overall business efficiency.
Style, experience, technology. Sounds comprehensive, but coming from inside, what's the big challenge for him? You mentioned market skepticism earlier.
Yeah, that's the crux of it. Can an internal successor, even a COO who knows the operations inside out, truly drive the accelerated change needed?
Right, the worry about entrenched groupthink, as some analysts apparently phrased it.
Precisely. Can he shake things up enough? Can he make Target faster, more differentiated, especially against digital native competitors, without that, completely fresh perspective from outside? That's what the market seems to be asking.
A show me story for the new leadership then.
Absolutely.
And speaking of speed, he's been leading this enterprise acceleration office, right? What's come out of that?
Yeah, he mentioned the Move Faster initiative. It's focused on streamlining HQ processes, getting rid of clunky old tech, automating more manual stuff, and just clarifying who's responsible for what so decisions get made quicker.
Trying to cut through bureaucracy.
Seems like it. And they're using tech practically, too. He mentioned deploying over 10,000 new AI licenses.
Wow. Doing what?
Improving forecasting accuracy, which is huge for inventory, and freeing up store teams from back-office tasks so they can actually help guests more.
Smart. Use AI for the grunt work. Free up humans for the interaction.
That seems to be the idea. And it looks like this focus on newness and innovation is actually bearing some fruit already in certain product areas.
Yeah, what categories stood out in Q2? Where did this newness drive growth?
Well, their Fun 101 initiative was a great example that's aimed at making hardlines think toys, home goods more stylish and culturally relevant.
Okay.
That category delivered over 5% comp growth in Q2, which is apparently its strongest quarter since way back in 2021. So when they hit that style note, it works.
That's significant. Shows the demand is there if the product is right. What else?
This one's pretty wild.
Trading cards?
Trading cards. Like baseball cards, Pokemon.
Yeah. Sales are up nearly 70% year to date. They're actually on track to potentially exceed $1 billion in sales this year.
$1 billion in trading cards. That's incredible.
Isn't it? A huge, maybe unexpected driver of traffic and sales. And then on the tech side, the Nintendo Switch 2 launch.
Ah, yes, the big one.
Target called it their largest video game launch ever. They apparently grabbed top market share among retailers. Shows their power when a hot product drops.
Definitely highlights their distribution muscle, for sure. And even in steadier areas like food and beverage, they saw slight growth, helped by little things like new floral offerings and trendy flavors.
So innovation matters across the board, even in small ways.
It seems so. And even in core areas like beauty, while overall sales were slightly down, the core stuff, skin, bath, hair care, those grew low single digits.
Resilience there. And apparel. Always tough.
Saw an acceleration, actually, particularly women's ready-to-wear and denim, so signs of life, perhaps, in their apparel refresh efforts.
Good to hear. But on the partnership side, there was that Ulta beauty news.
Right, big announcement. They mutually decided not to renew the shop-in-shop partnership with Ulta when a current deal ends in August 2026.
So those little Ulta stores inside Target will be going away.
Looks like it. Target says they plan to repurpose the space, maybe for their own beauty brands, maybe something else entirely. But it suggests they feel confident going it alone in beauty now.
Interesting strategic shift. Okay, let's switch gears back to those operational headwinds. Tariffs. How are they fighting back?
They talked a lot about mitigation efforts, cross-functional teams working hard, basically.
Doing what specifically?
Revising product plans, shifting production to different countries to diversify away from tariff-hit regions, changing up the assortment.
Trying to dodge the impact where they can.
Exactly. They said the bulk of the one-time costs, like canceling orders already placed, probably hit in Q2.
Okay, so maybe the worst of that initial shock is over.
Possibly for the one-offs. But they were clear that the ongoing direct cost impact from tariffs will remain. It's not disappearing.
And how are they handling that cost? Passing it on.
They emphasize that raising prices is a last resort. They want to maintain their value proposition, so they're trying to absorb costs internally as much as possible.
A tricky balancing act, especially now. What about inventory levels overall? Are they managing stock well?
Inventory dollars were up about 2% year over year at the end of Q2.
Okay, driven by
mostly investments in frequency categories, stuff people buy often, and just higher product costs due to inflation. But importantly, the actual number of units was down low single digits.
So fewer items, but they cost more.
Pretty much. And management sounded confident about their position heading into Q3 and the holidays after making some planned adjustments.
Good. And you mentioned shrink earlier, that improvement was quite significant.
Very. It provided a 130 basis point benefit to margins in Q2 alone. That's huge.
Wow.
And for the full year, they're now expecting about an 80 basis point benefit from lower shrink, basically getting back to pre-pandemic levels of loss.
That's a massive operational improvement. Suggests their loss prevention efforts are really working.
Absolutely. It's a bright spot in the margin story.
Beyond inventory, how are they using their physical stores? That's always been a strength for Target.
Still leveraging them heavily as fulfillment hubs. Nearly 2,000 stores acting as mini distribution centers for online orders.
The store's fulfillment model.
Exactly, and they're refining it. They mentioned a test in Chicago where they're actually differentiating store roles.
How so?
Some stores are becoming more focused on just packing digital orders efficiently. Others are focusing more on the drive-up and order pickup services and the in-store guest experience itself.
Specializing the stores based on local needs or layout.
Seems like it. The test showed promise, improved efficiency, so they're expanding that differentiated model to 30 or 40 more markets.
Smart optimization. So, with all this activity strategy shifts, operational tweaks, how are they allocating capital? Where's the money going?
CapEx, capital expenditures, were about $1.9 billion so far this year. Full year target is around $4 billion.
And that's going towards?
Pretty much aligned with Fidel's priorities. New stores, remodeling existing ones, supply chain upgrades, and technology investments.
Makes sense. And shareholder returns. Dividends, buybacks.
They paid out just over $500 million in dividends in Q2, and the board just approved a 2% increase in the quarterly dividend for Q3.
Okay, so still committed to growing the dividend, even modestly.
Seems so. But on the share buyback front, they didn't repurchase any shares in Q2.
Oh, why not?
They cited the tariff uncertainty, playing it cautiously with cash.
Holding back a bit.
Yeah, but they did hint that buybacks might cautiously resume in the second half of the year, always stressing they want to keep their credit rating strong. It's that balancing act again.
Flexibility versus returns.
Got it. Okay, let's pull back to the bigger picture, the investor context. That initial stock drop, nearly 7%, despite some beats. What was driving that negative reaction?
It really comes back to that skepticism we touched on earlier. Analysts just weren't entirely convinced by the internal CEO pick.
The entrenched groupthink concern.
Exactly.
Yeah.
Some commentary basically said, this doesn't fix the core issues. Others pointed out the huge challenge Target faces competing in an increasingly digital world they see as steep uphill battle.
So the market wanted maybe a bolder move, an outsider perhaps?
That seems to be the subtext. There's a hunger for more radical change, it seems, to really adapt to how quickly retail is shifting. And the broader economic climate isn't helping, I imagine.
Definitely not. The call highlighted ongoing volatility, uncertainty around tariffs still, and concerns about consumer spending power.
People being more careful with their money.
Right. Management acknowledged that price sensitivity. Their strategy for back to school and the holidays is explicitly value plus newness. They need both affordability and excitement to win those dollars.
Makes sense. So looking forward, what are the key things investors need to see from Target in the next few quarters?
Two big things. One, they need to see comparable sales start growing again, or at least stabilize convincingly. That 1.9% dip needs to reverse.
Get the top line moving in the right direction.
Exactly. And two, they need to see margins stabilize or ideally improve. Can they manage those costs, improve shrink further, and maybe get some pricing power back eventually?
Sales growth and margin stability. The classic retail metrics.
Pretty much, especially as they navigate this choppy, tariff-blurred retail landscape, as one analyst put it. The new leadership under Fidel really has to prove they can execute and get that merchandising right.
A lot riding on the next few quarters then.
For sure.
All right, well, before we wrap this deep dive, it's time for our signature segment. This is not financial advice, where we throw out a potentially wild but maybe plausible trade idea based on the earnings call.
Gotta love this part. And today's idea, we're calling it the trading card catalyst.
Inspired by that billion-dollar projection for trading card sales at Target this year.
Yeah.
Just phenomenal growth in that specific niche.
Totally unexpected, right? So here's the outrageous but plausible idea for the bold traders listening.
Lay it on us.
Consider setting up a short strangle options position on a pure play collectibles company, maybe Tops if it were public, or a similar entity, let's just call it Collectico for now.
Okay, short strangle on Collectico.
And at the same time, take a long position in target call options.
All right, break that down. Short strangle means you're betting Collectico's stock won't make a huge move, either up or down.
Essentially, yes. You sell both an out-of-the-money call and put option, collecting the premium, hoping the stock stays within a certain range so the options expire worthless.
And the long target calls. It's a bet target stock price will go up.
Right. So the core thesis is this. Trading cards are a real, perhaps underappreciated driver for Target right now. They bring people into the store.
That crucial foot traffic.
Exactly. While Collectico is the pure play beneficiary, it might be overhyped or face volatility if the trend cools. So the short strangle on Collectico tries to capture that premium, betting against extreme moves.
Okay.
But the long target calls bet that Target, as the massive, diversified retailer with huge distribution, can better leverage this trend. People come in for cards, they buy other stuff. Target benefits more broadly.
So you're betting on Target's overall retail strength and curation ability, fueled partly by this niche trend, versus the potentially more volatile pure play company.
Precisely. It's a play on Target's power to turn a specific trend into broader sales momentum, while hedging against the niche player maybe being overvalued or the trend itself fizzling for them specifically.
It relies on the trend having legs and Target continuing to execute. But yeah, I can see the logic. Stranger things have happened in retail.
Definitely qualifies as outrageous but plausible. Something to chew on.
Absolutely. So to wrap up our deep dive today, Target's Q2 showed a company deep in transition. New CEO on the way, shifting strategies.
Yeah, you see some operational wins, digital growth was solid, that shrink improvement is genuinely impressive, and certain categories are responding well to newness.
But the market's caution is loud and clear. It underscores the big challenges ahead for Michael Fidelk. He needs to accelerate performance, rebuild that investor confidence.
That focus on making the merchandise unmistakably Target, elevating the experience, leveraging tech, those aren't just talking points. They really have to deliver on those fronts in the coming quarters.
It's a pivotal time for them, no doubt. Watching how they navigate this will be fascinating for anyone interested in retail.
Couldn't agree more.
Well, that's all the time we have for this deep dive. Thank you so much for tuning in. We want to know what you think. What stood out to you from Target's call? Keep exploring, keep questioning.
And join us next time for another deep dive.